Hey everyone, I'm here with Nate of Bancor. And Nate, why don't you tell us what your role is with Bancor?
Yeah, sure. I work on the growth team, so that's everything from um, marketing, communications, partnerships, BD.
Okay,
We're a pretty small, nimble team, so got my hands in a lot here.
nice. And you're in Tel Aviv, Israel, is that right?
Yep. So Bancor is based in Switzerland, but we have our sort of main R&D office in Tel Aviv, Israel.
Nice, cool.
Yep. It's about 50 people in this office.
Oh, okay, wow.
Yeah.
Well, thanks for
Yeah.
taking the time. Just
Yeah.
for some context for everyone, I had learned about staking your assets in Uniswap's liquidity pools. And I had kind of posted online. I was trying to ask for someone to explain to me how this worked. And that's how I got in touch with Nate because Bancor also uses liquidity pools. And it turns out the answer to my question is a bit more complicated than I thought. Because as it was advertised to me, and the way I thought of it was just sort of, oh, I'll throw my assets in here and I know that they're going to accrue more value over time. But Nate has started to explain to me that it's a bit more complicated than that. So I think we're going to get to that down the line in this conversation. But I just want to provide everyone a little bit of context for what we're going to talk about because that benefit, I guess, is a little more, there's other considerations that you need to have as you explained to me.
Definitely, yeah. Bancor's been experimenting and working and productionalizing on-chain liquidity pools since late 2016. So we have a couple of years under our belt with sort of seeing how these new type of instruments work.
Yeah.
And just in the past, I'd say 6 months, that folks are really starting to like awaken to the power of liquidity pools
Sure.
and how it's a fundamental reinvention of sort of status quo
Yeah.
in asset exchange. So
Cool.
yeah, excited to dig in.
So let's start out a little bit just by telling people what Bancor is. When I've used it before, it just sort of, I've interacted with it in the same way I would a decentralized exchange, a DEX. I could just go there and kind of swap tokens. But as I understand, it's not like, it doesn't have an order book. There's liquidity pools that are behind each exchange. So maybe you could tell us, like my first question for you was, is Bancor a DEX? Would you consider it a DEX?
Yeah. So Bancor, a lot of people call it, like you said, and it feels like a DEX.
Mm-hmm.
We don't consider ourselves a DEX,
Okay.
and here's why. So from the user's perspective, the experience is similar to a sort of non-custodial exchange or decentralized exchange. You send Bancor one token and you get another in return without having to give up custody of your tokens at any time.
Mm.
Right? So on the front end, from the user perspective, it's quite similar. But behind the scenes, the mechanics to process these conversions is entirely different. So Bancor works on a peer-to-contract model instead of peer-to-peer order matching. So like you said, we don't have order books. We entirely remove order books from the equation.
Right.
And in the peer-to-contract model, a user is trading directly with a contract instead of order matching taking place between a buyer and a seller in order to facilitate conversions.
Sure.
So understanding how peer-to-contract conversions work, it's important to first identify the kind of main groups of users on Bancor. And there's two sort of main groups.
Okay.
One is end users who are performing the token conversions on Bancor.
Mm-hmm.
And then the second are the liquidity providers who supply liquidity to Bancor in exchange for fees from these token conversions. So you can kind of think as liquidity providers as sort of nodes in Bancor's decentralized liquidity network, right? And then so when a conversion is processed by Bancor, it's processed by this network of on-chain liquidity pools, right?
Okay.
And each liquidity pool is essentially a smart contract that's created and owned and managed by a third-party liquidity provider.
Okay.
And so Bancor is a permissionless protocol, so anyone can create a liquidity pool on Bancor without having to deal directly with Bancor's core development team.
I see.
And a liquidity provider might be the founders of a token project, or just a user who simply wants to add liquidity to a token on Bancor and then generate fees from its trade volume. And that's really the primary incentive for contributing liquidity on Bancor, are these fees that are generated from each conversion.
Okay.
And the way those fees work is that each liquidity pool, we call it a Bancor relay, can be programmed to take a fee from each conversion. And generally, the fee is ranging from 0.1 to 0.3% of each conversion is kind of what we recommend. But it's really up to the liquidity provider to program and take whatever fee from the conversions that they want. So it's really up to them, though it's worth noting that the relays with the most competitive fees will likely get the most conversion volume.
Okay, that makes sense.
Right.
So I want to run my understanding of a liquidity pool by you and see if I pass the test or not.
Go ahead.
So my understanding of it is so you have two assets that make up a liquidity pool. One is the token that you want to provide liquidity for, and then the other one, in Bancor's case, is Bancor's token. Is that right so far? Okay. Yeah. And what it does is
Bancor's token being BNT.
I'm sorry, BNT.
Right.
Okay. And so the way that this works is you have a ratio of the token that you want to provide liquidity for and the BNT token. And when somebody wants to do a swap, actually, hold on. So I guess I'm missing one little piece. If I want to, let's say I want to exchange, can you throw out a token that does liquidity?
Let's call it DAI and BAT, basic attention token.
Okay, perfect. So let's say I wanted to go from DAI to BAT. Each of those has its own liquidity pool that has BNT sitting beside it. And it's the ratio of the BNT to DAI and the ratio of BNT to BAT that determines the price that you're going to pay for each. Is that about right?
Yeah, okay. Exactly.
And my other understanding of liquidity pool systems is that they rely on order book exchanges and arbitrage to maintain the accurate ratios. Is that a right way of describing that?
I wouldn't say we don't rely on order book exchanges at all. We do rely on arbitrageurs to balance the prices.
It doesn't matter what they do with it, though, is what you're saying. It doesn't matter if it's an order book exchange. It's just the arbitrage opportunities.
Right. Gotcha. Right. It's the actual arbitrageurs that are doing the trading. And the liquidity pools are totally disconnected from any external price feeds.
Sure.
They're just black boxes. Right. They're black boxes that know how to do one thing, and that's to balance the ratio of their base token and also what we call the network token. So, and they balance it. So when one is sort of sold, let's say the amount when it's sold, the quantity of the base token, let's say you're selling the base token to the reserve, increases, and that's in relation to the quantity of the network token. And in order to balance out the prices, so to make sure that the ratios are equal, you would then have to decrease the price of the sold token, of each of the sold tokens, and sort of increase the price of the network token to make sure that the liquidity pool always considers them 50-50. And so how that happens is, say, like we said, that example, when you're going from DAI to BAT, you would essentially you want to use your DAI to buy BAT. You would send your DAI to the DAI liquidity pool, right? And behind the scenes, and you would say that you want that. Behind the scenes, DAI is converting from BNT, and within the DAI liquidity pool, the BNT is getting sent to the BAT liquidity pool, and then the BAT liquidity pool is popping out your DAI.
Gotcha.
And those changes in quantities are then adjusting, so the value of DAI will get changed. So we'll drop algorithmically along this predetermined price curve. Whereas because you've withdrawn BAT from that liquidity pool. Remember, in order to balance out, the price of BAT will have to rise.
Sure.
So each conversion is sort of having these effects on the price along these pools. And now when the price of a token diverges from the price of that token, remember these are black boxes, these liquidity pools, when it diverges from the external markets, there's an incentive for arbitrageurs to come along and to either buy or sell that token, and that ends up balancing the prices so that the prices on Bancor within these black boxes matches that in external exchanges.
I see. Yeah, that's really exciting stuff. Yeah, it does.
It's cool. I mean, it's like, asset exchanges have worked a certain way for hundreds and hundreds of years, right? You have a bid and you have an ask and you have an order book, and you match the two in order to complete a trade. And what we've essentially done in the crypto world, or what's happened in the crypto world, is we've just replicated this bid-ask model in decentralized and centralized exchanges. And so these liquidity pools really fundamentally alter that status quo. All of a sudden, when you don't need a buyer and seller to facilitate a conversion, there's no liquidity, there's no counterparty risk. You could always buy and sell the currency at some price.
Right.
The liquidity of that token is not determined by the amount of buyers and sellers of the trade volume. The trade volume is completely disconnected from the liquidity. The liquidity is actually dependent on the amount of inventory that's deposited in the liquidity pool or inside the relay.
Yep, that makes sense.
So there's all these kind of new mechanics that we feel really change the game.
So I was actually curious, as we've talked about this, is there anything else that came before Bancor that uses this sort of model, or is this actually a new model?
Yeah, not to our knowledge. This was, we started talking about this stuff we started developing it behind the scenes in 2016, sharing it with the community around that time. And then in early 2017, started being public. And then in June 2017, had this token sale and launched the network. So that's really when we productionalized it. And then, we've seen a lot of growth in the past 2 years. There's been something like over 2 billion in conversions processed through these liquidity pools.
Right.
We've seen over 150 liquidity providers plug into the network. And again, you plug into the network by just creating a smart contract with your token or a token you want to provide liquidity for, and then BNT, which is this network token that facilitates these conversions between liquidity pools.
Sure.
So yeah, we were kind of, the first to sort of bring this model to the market. And since then, and more recently, we've just seen an explosion of interest in this idea of decentralized liquidity.
Sure. And so you've sort of told the story of Bancor. Can you put Uniswap's project in the context? My understanding is that they were funded through the Ethereum Foundation, I think. Is that right? Yeah.
So, you can actually track it back to, there was a bunch of articles where there was some articles written about Bancor. And then I remember Vitalik, the founder of Ethereum, had this long comment about Bancor too, and a lot of people were discussing the model. And then the founder of Uniswap, Hayden, has spoken at length sort of how he was sort of inspired by this initial commentary on Bancor's model. And what a lot of folks were saying at the time is you don't need BNT, you don't need a custom token to build these types of liquidity pools.
Sure.
Remember, go back to liquidity pools, you have the token you're contributing liquidity to, and then you have the network token that facilitates trading between them and manages these reserves. And a lot of folks in the Ethereum community were saying you don't need BNT. You can just use Ether. Why not just use Ethereum? Yeah. And so what Uniswap did is they cloned Bancor's model, and they forked, all the code is open source, so they forked the code, they forked the formula, and instead of BNT and the liquidity pools, they introduced Ether. And So when you trade on Uniswap, it's the same functionality as Bancor, but instead of going through BNT, you're going through Ether.
Sure.
And so there are a lot of limitations from our perspective of introducing a blockchain level token like Ether instead of using a custom token.
Okay.
And we've also seen folks implement these strategies locally on different blockchains too. Like there's another one that's done it with EOS in the liquidity pools.
Okay.
And there's TRX, which is on Tron. That's an implementation of Bancor. And all these are local implementation of Bancor's model. The real drawback, there's a couple, but we feel the real drawback of using a blockchain level token is really happens when you try to go cross chain. When you want to transfer an Ethereum based asset through this mechanism for a EOS asset. Yep. It becomes way, way less efficient and way harder to build, and will increase a lot of cost to do this, to have to go from the token to Ethereum, then Ethereum to EOS, and then EOS to the EOS-based asset, instead of going directly through a custom token. And you also tie your network then to the blockchain you're on. Right. So given how inefficient it is to go cross-chain, you're not only tied to kind of the performance and any constraints that arise in the network, but if that blockchain goes down, then you're kind of screwed. You can't just sort of easily shift to the other blockchain. So cross-chain conversions become way less efficient. Okay. And it was actually it was mid to late last year, Bancor expanded to EOS. So, BNT was turned into a cross-chain token, and you can now do, single-click conversions from EOS-based assets to Ethereum-based assets and vice versa via the protocol. Okay, and that's expanding to additional blockchains from Tron to Bitcoin. Sure. And so this kind of multi blockchain world is one we're envisioning, and we think that's way more efficient with a custom token. Another benefit by using a custom token is you can start to introduce very interesting incentives when you can tweak the custom token. So when the community can say vote on changes that they want to BNT, for instance, to do some inflationary mechanism, have that inflationary mechanism targeted at a specific liquidity pool to incentivize, more conversions or more liquidity being provided to that pool. Right. To be able to do that through a custom token is way easier. If you wanted to do that to Ether and implement that in Ethereum, you kind of have to go through the Ethereum Foundation to do that.
Well, and it would affect the entire Ethereum network, right? Like you can't tweak things quite as targeted like you could with a custom token. Yeah, I follow.
So we think there's all sorts of benefits. I mean, that said, we couldn't be more thrilled to see the growth of Uniswap and Ethereum. It's hugely validating for the model, and to see folks joining as liquidity providers and the stake liquidity going up, and its contribution to DeFi. We're super psyched to see that kind of validation, and it's been awesome. We just do see some drawbacks with using a blockchain level token as your sort of network token in the liquidity.
Yeah, that's an interesting consideration. I would love if you could tell me a little bit more about the like I started this conversation with, basically about how I did actually stake a small amount of tokens or provided liquidity on a particular pair on Uniswap, and so with the promise of earning, I think, 0.3% of each trade, right? But I also noticed as time went on that the amount of my assets was changing. So like one of them went down and one of them went up. And I haven't actually been able to figure out if like my total value has gone up or down, in part because one of the assets is Ethereum and the price of that changed so much. I'm having a hard time wrapping my head around whether it was a good idea.
Yeah,
And
I think you're not alone.
that was actually kind of the impetus. I'm looking at these numbers going, I need somebody to explain to me what's going on here. So you kind of said there was some risk inherent in this. So
there's definitely a misconception. You know, we're at let me start off. We're at a moment in time where folks are starting to awaken to sort of the power of decentralized liquidity. The fact that anyone can contribute to the liquidity of a token and generate rewards and incentives off of conversions in that token. And there's tons and tons of excitement about it. And you know, the stake liquidity in Uniswap is also a validation of that. There's a big misconception in the community right now that you know, you just stake your idle assets in there and you generate fees off the conversion volume and you're just going to get interest. And that's really not the case. These are still at this stage super risky vehicles, right? And so I want to take you back in time when Bancor initially launched. We had a way where you could, you know, we call them relays instead of, you know, on-chain liquidity pools. We had a way that you could buy the actual relay token. And essentially what you're doing is just like you can do in Uniswap today, you're contributing liquidity, and that gives you rights to a portion of the liquidity that you can withdraw at another time. And if you have a bunch of conversions and that each conversion is depositing more liquidity in that pool, you'll see it go up. But what we discovered is that when there's a lot of variance in the token prices, essentially when one of the tokens is rising in the external market, the relay or the liquidity pool will end up selling that token to users. And when one of those tokens is dropping, the relay will end up buying that token too. And so what can end up happening is you get this, what people have called impermanent loss, when there's a large sort of variance in the initial ratio between the two prices, right? And so you can actually, even if it's generating a lot of fees from the conversion volume, the loss that you generate from the variance in these token prices when they're constantly moving the losses can be greater than the fees that you generate from the conversion volume.
Is there a way that you could provide an example, maybe with some really simplified numbers of how that might happen with this impermanent loss? Is that something that's possible?
Sure.
or an example that happened in history?
Yeah, I mean, you can just there's actually tons of, and maybe you can link folks to blog posts that have been written about sort of impermanent loss in Uniswap liquidity pools. There's kind of tons of there's tons of literature on it. I think sort of the easiest way to look at it is if the ratio is staying relatively consistent between the prices, you're going to win. The volume, the fees based off the volume are going to, you know, put you over the top, and you're going to generate interest. But the second that one of the tokens drops a great deal in value, and this is again on the external market or rises a great deal, you're typically and that you run the risk of that, you know, being more than the fees that you can generate off of the volume.
So in the example of a pair like DAI and Ethereum, let's say you were providing that on Uniswap, are you saying that fluctuations in the price of Ethereum, like particularly rapid ones, could result in you having an absolute lower number of DAI or Ethereum, like in a way that reduces your? It's hard to explain because the USD value also just changed when it did that movement, right? But you're saying that like the total value of your DAI and your Ethereum could actually end up being lower.
Yeah, exactly. And also with DAI, you know, this is still sort of in research and and a lot of folks are experimenting with, implementing these liquidity pools with a stable token on one side,
Okay.
and a price elastic token on the
Right.
other.
Mm-hmm.
But there's one last sort of variable to consider. The ratio may not swing as much if you have a stable token
Mm-hmm.
on one side and then a price elastic on the other.
Okay.
Where, as opposed to having a price elastic token on both sides. So
Okay.
so there is some thinking that it could, not necessarily, but it could be sort of less risky for liquidity providers to provide liquidity to a liquidity pool that has
Okay.
a token.
I see.
Right. So, and then also, we can see that some of the returns for the DAI pool are particularly attractive on Uniswap because the trade volume is high. There's not,
Sure.
you don't see DAI listed on a lot of exchanges, and
Right.
so it being one of the largest sources, liquidity on Uniswap, the sort of trade volume is producing, compared to some of the other tokens, some favorable returns.
And what's interesting about that actually is when I looked at a website that was meant to estimate the returns,
Mm-hmm.
the trade volume was similar, or sorry, the estimated returns for providing DAI was similar to what you might get if you put it on Compound or Dharma or Nuo or one of those sites. And what's interesting about that is when you have an asset that has an opportunity cost for staking, or not really staking, but locking up somewhere, like people aren't going to put all their DAI on Uniswap if they're only getting 6% when they could get 12% on Compound, right? So it creates like this interesting dynamic where the liquidity pool might not be ideally funded by virtue of the fact that DAI is in demand elsewhere. Do you follow what I'm saying in that way? Or do you think that that's an accurate conclusion?
Yeah. And I think that, like, you nail it on the head too with the opportunity cost. It's not necessarily that the liquidity pool might generate a loss. Or the loss has to be taken in comparison relative to what else. Mm-hmm. So we consider it kind of a pure impermanent loss if the gains that you would see by just holding the two assets on their own is greater than having them staked in these liquidity pools. And often that is what we found, is just holding the two assets is better than, in its rawest form, having them staked in the liquidity pools.
Okay, so that makes sense to me. So like I said, I have this. I think I put in like 1 Ether worth of liquidity on each side of this pair. Mm-hmm. So what I'll do, just for my own education, I'll analyze. How would I do that? So I contributed CDAI and Ethereum to mm-hmm. Uniswap, right? And I'm mm-hmm. looking at the numbers, and I have like less of one asset and more of the other. The value of CDAI and Ethereum has changed since then. So I guess what I would have to do is look at how much CDAI and ETH I put in, and then compare the value of that based on today's prices as if the numbers had been the same, and then compare the numbers I have now to see if I've been in the green or not, or in the black or not.
Yeah. Look at your kind of historical returns if you had just held them on their own.
Okay, so that helps me figure that out.
So that's I mean, this is the current day situation, right? And so from Bancor's perspective, we had this, amazing innovation, and we saw that for everyday users, it's particularly risky. And a lot of the Uniswap and DeFi community is now discovering this sort of high risk of impermanent loss. Okay. So it's like, where do we go from here? And Bancor is investing a lot of time in figuring out, how we can start to de-risk these liquidity pools, and how do we empower and work ourselves to launch a product that really does allow everyday investors to stake their assets and generate a somewhat reliable return off these conversion volume, and how do you rebalance assets, what assets should be in the liquidity pool in order to kind of optimize for liquidity provider returns. And so we think we're quite close. We've worked with several kind of third-party developers on releasing a sort of second layer product that allows everyday investors to be liquidity providers without facing what we think is kind of is quite a large risk.
I see. Interesting.
Yeah.
Yeah, I'll be curious to see what that looks like. It seems to me, without fully understanding liquidity pools, but I'm starting to get it. But it seems to me it would be an important part of the whole system that people are exposing themselves to a bit of risk. That would just be inherent to it. So I'll be curious to see what solution you guys have come up with.
Yeah, I'm not suggesting that it gets fully de-risked,
right.
But just that that it's less risky from its current state. And I think if you look at in your own experience, and if you look at some of the returns on Uniswap liquidity pools, you'll kind of see that it's quite risky.
Okay.
And it's quite hard for the everyday user to understand the sort of complexities and to optimize their contributions to liquidity, and also to monitor it. When do I pull out? When do I pull some out? When do I add some more in?
Sure.
It's quite cumbersome at this stage.
Right. Yeah.
So
for sure.
It's kind of this sort of constant trade-off in open finance, which you want to release new stuff as fast as you can, and you want to make it as open and as you can, but you can there's sort of this balance and this trade-off between openness and sort of user safety. And suddenly when something is only profitable for the most advanced users, it sort of undermines the actual openness of DeFi and open finance, because it's not the sort of profit opportunities are not accessible to everyday users.
Of course, yeah. And with Mosendo, the project I'm with, like being usable is our main goal, and essentially we desire to make DeFi accessible to everyday users as well. So I like the idea of finding a way to make it quite easy. Basically, I think of this stuff as like I try to understand it so other people don't have to. But obviously with liquidity pools, you can't just promise, oh, you're going to earn X% interest and don't worry about it. So if Bancor can find a way to be able to say that and mean it, I think that would be really useful, to where it's not quite this level of complexity, for sure.
Sure. Definitely.
Yeah. So thanks for explaining how those pieces work.
Sure.
One question I've been asking people, because it entertains me, is if just imagine that you're like at a family dinner and your uncle asks you what you do for work. How do you explain like what your company does to like a non-crypto person?
Yeah, wow, good question. We have this vision that we've been told this lie our whole lives, that the single currency system is the solution to maximize efficiency and efficiency.
Okay.
Right? Like we can exchange things more easily because we have this single currency system. And we here at Bancor sort of started actually as a kind of community currency company. We spoke about this a little earlier,
right.
Which is that we have this view that there will be millions of tokens in the world, but tokens in the current stage are fundamentally failed. This is like the new and the niche and the sort of smaller scale currencies are fundamentally failed by the current exchange system.
Okay.
This sort of bid-ask model that we spoke about before, the need to have lots of buyers and sellers in order to have lots of liquidity. When you're an illiquid asset, you're easily gameable. There's lots of volatility. There's counterparty risk. So we feel like there has been this up until now, before peer-to-contract stuff, before DeFi, before on-chain liquidity pools, there was this barrier to liquidity pools faced by the vast majority of these sort of new and niche currencies. And now we're finally at a stage where you don't need tons of buyers and sellers in order to make a currency viable. The liquidity is simply determined by the amount of inventory that's deposited in a smart contract. And you can have liquidity from day one of your currency, and that we feel will make it as easy to launch a token as it would be to, you know, upload a YouTube video. And, you know, what's really happening in blockchain from my perspective is, you know, you haven't only increased the amount of people that can be supporters or investors or stakeholders in a network, right? It's like mind-boggling as is to think that all of a sudden we've taken fundraising from Silicon Valley to having 10,000 shareholders in, you know, an early stage venture through token sales, right? So that's one thing. So we've not only expanded the pool of who can be an investor, but we're expanding the pool of what can be sort of investable. You know, it's sort of this atomization of funding. We've started with, you could say, companies and, you know, the traditional, the real estate and the mutual funds, but, you know, all of a sudden, if you can purchase anything or anyone's token, you can participate in the growth of their network. And that could come all the way down to, you know, a digital content creator launching their own token, and as their community grows, the value of their token grows.
I see.
So I that's just a very long-winded, and I would have probably lost the dinner table.
I think you failed the family dinner table tests.
Failed that big time.
But I appreciated the answer.
Hopefully that resonated with your audience. And
it certainly resonates with me. Yeah.
Nice. This idea of constant liquidity is just like it you know, flips everything on its head right now, and we think we're just in the earliest stages of it.